Retail sales during the month of October cooling as consumers pulled back on discretionary spending amid sticky inflation. Yesterday was a big day for the markets. The rally staged broad gains after October's CPI inflation report cooled more than expected. And Maddie, when you take into account what happened yesterday and then what the early action that we're seeing this morning in futures, all three of the major averages pointing higher once again, I think many on the street are asking whether this rally can continue and what exactly that upside looks like.
Right. There was a little bit of commentary yesterday about whether or not there was a little too much euphoria in that rally just because it was the biggest S&P 500 day since April. But I want to take a look at small caps because that could be one indicator that we are going to see this rally continue heading into the second half of the year, November and December there. If you look at the Russell 2000, up by 5.4% yesterday. That was the most gains in the Russell in all of 2023, and seeing some trading in those small caps could be an indication that traders that have had some dry powder waiting on the sidelines are ready to get in on some riskier plays because they've decided that, you know, the Fed, at least from the market's perspective, the inflation fight is over. We'll have to wait and see if Jay Powell agrees with that, right, guys?
And so on the retail sales front, I mean, we've got a range of data that either showcases a lot about the consumer, whether that's the inflation that they're still waiting through, that came yesterday, but also how much it's costing producers to produce services, goods right now. But then additionally, just where retail sales are holding up. We got that most recent print for October. What's the action that we're seeing across those names as we're considering and continuing to get more of a read-in on the consumer?
Yeah, I think it's really interesting that we saw that 0.1% decline in retail sales. The street was looking for 0.3%. That meh kind of number, some would call it Goldilocks, I call it meh, feels like something the street is excited about, right? Because it's not a sign that the Fed is going to have to continue their inflation rate hike to fight inflation. But it's also a sign that the consumer, okay, they're cooling off a little, but they're still going to spend money to keep those fundamentals good for those companies that are reporting earnings still. And we got some of that detail from Target and TJ Maxx this morning, beats from both of those names. I'm really curious to hear on their calls later today, and I know Brooke will talk about this with you guys, whether or not the story for those retailers is consumers trading down, and that's why we're seeing more movement into TJ Maxx, or if this is consumer resilience because of more credit, and that's not going to be a great thing either for the economy.
Yeah, and I think that's exactly what we're trying to figure out, right? We know that consumers have been under a tremendous amount of pressure when we talk about the fact that inflation has been sticky now for so long. So it's the fact that, yes, they are still out there spending. Many times it is on staples. But what was interesting in this Target report was that they did spend more than maybe we had expected on beauty. There were some areas that maybe would be considered a bit more discretionary, yet consumers are still willing to spend. And when you tie that to what we saw in the retail sales report that was also out this morning, yes, they are still spending on personal care. They are still going out and spending on grocery stores, but 7 of the 13 categories did post declines. We talk about people aren't out there spending on discretionary items, furniture, car dealers leading those declines there. So people holding back on some of those larger ticket purchases, which is very similar to what we heard from the earnings report in Home Depot yesterday.
Yeah, that's right. And for Target, I think that if there's anything that should jump out to investors who are trying to figure out why this stock is moving higher, 14% pre-market here, especially after the company had the number of transactions and average check size decline during the quarter. You also had comp sales down year over year, digital comp sales down 6%, and store comparable sales down 4.6%. All that considered, it doesn't spell out a consumer that's continuing to increase the basket size when they go into this store. And so being very nitpicky about where they need to spend versus what they want to spend on is one theme that continues to show up, and especially even within the most recent Census Bureau data that came out this morning around retail sales in some of those more discretionary categories right now.
Well, and then you consider the CPI data, the fact that the biggest contributor to the upside on CPI was housing. So if that continues to be the case, how long are we going to continue to see consumer spending? And to your point, Brad, if we're already seeing some cracks in the pavement here, what's that going to look like heading into 2024? Is this rally going to be justified?